Welcome back. And with me is Alan Valdes, a senior partner at Silver Bear Capital. Also Nicole Petallides, a host at TD Ameritrade, and Massud Ghaussy with the Nasdaq, so Investor Relations Intelligence. So welcome. We're going to talk about this crazy market that we have been seeing since October. It's unbelievable. I've been covering the market for a while now. And I know, Alan, I mean, have you seen anything like these unbelievable moves that we're seeing in the market?
Even during the crash in '87 and other, nothing as volatile as this. This is insane. But you know, it's all this uncertainty that's really rolling the markets, whether it's China, whether it's the dollar, whether it's oil, whether it's the tariffs.
Interest rates.
Yeah. So I think it's going to stay with us for a while.
Yeah, I mean, we're up 700, down 1,000. I mean, that's...
Yesterday, a quiet day, there was a 600-point swing, you know, so it's nuts. It's just crazy.
So, and then also, Massud, what do you think is leading to this extreme volatility that we're seeing?
Sure. So, Jane, there are three forces at play here. One, we have the unwinding of one of the biggest experiment in monetary history of the United States, perhaps, or the world, I should say.
That's true.
So it's the ending of a accommodative monetary policy. Typically, when Federal Reserve or central banks unleash liquidity into the system, they take volatility out and they juice up returns. So the reverse is happening. And this all happened because of the financial crisis of 2008. So that's reversing. So that's a lot of uncertainty there, one. Two, we have a slowdown in global growth in the United States, emerging markets. And third, trade tensions. Tariffs are essentially a tax on U.S. consumers and businesses. And as taxes, essentially tariffs go up, this slows down global growth and slows down trade. So those are the three forces at play that have brought volatility in the markets in 2018.
Yeah, and we're still seeing a pretty strong economy. I mean, that jobs report that we got for December was just a blockbuster. I mean, Nicole, it still seems like the economy is doing well, but everybody's kind of worried about what may happen.
Right, and what we're seeing, that blockbuster report, 312,000 non-farm payrolls, right? So you are seeing jobs being added, and that's been a wonderful trend. Wage growth, that's what I love to see for Americans.
So we're waiting on.
So that was some great news. But what's a little bit worrisome, and this is one of the reasons why we see volatility in the markets, is that you start to see headline risk. So you get a good headline, great jobs report. Then you get a bad headline. Manufacturing is weaker. And that's one of the reasons why we've seen this volatility. And I just had a conversation with Danielle DiMartino Booth. She wrote the book Fed Up. She was an advisor to the Fed itself. And one of her major concerns is recession in the back half of this year. And that, at least in part, is because of what she's seeing. Manufacturing actually got hit very hard in the regions. When you look at Texas in particular, and also just saying households better gear up for a somewhat worrisome back half of the year. Listen, I have no crystal ball, but you do get mixed reports. Love seeing that the economy has done better, certainly since the financial crisis, which Massud referenced, but we'll see. I think it's a much more, we'll see. And if you don't get the hikes, that would probably be helpful.
That would be helpful. Well, and that's one thing we learn about markets over the years, is that they tend to kind of look ahead many months into the future, Alan. So, I mean, is that what we're seeing? Are we seeing a fear of a slowdown, you think, in the second half?
I think, you know, we'll have a good first quarter, but I think you will see a slowdown. I mean, we're seeing it, our biggest trading partner in Europe is having a slowdown over there, and that's going to weigh. You see the dollar going down here today. But I think basically the markets, I don't know if we're going to recession, but we're definitely going to slow down.
Going to slow down. Well, we were kind of off to the races there, especially in 2017. It was like an 80 stock market records set, but you brought up the financial crisis and how we're kind of readjusting back to normalcy. I mean, it's taken 10 years. And that was one of the things I was watching as President Trump was criticizing Jerome Powell. And I thought, well, Jerome Powell, here he is trying to get things back to normal with interest rates, but, you know, he's rocking the stock market too. So it's kind of a tough needle to thread there. Wouldn't you say, Massud?
Oh, absolutely. I mean, it's a delicate balance of, you know, timing the markets and also looking at growth in the labor markets and inflation. What can be said about the Federal Reserve is, I think, over the long run, if they continue their dovish stance, it will create a more frothy market. So it's a double-edged sword from that perspective.
Yeah. Now, Alan, typically when we go through these times of volatility, it's a good time to hold on to stocks and not sell. I mean, I've had friends texting me from back home, should I sell, should I sell? And I'm like, no, don't. It's always scary to make that call, but historically we've seen it's good to hold on. Yeah,
you know, we're telling our clients, don't panic, hold on. We're saying actually getting cash right now. We're taking advantage of some of these drops. Like, you know, we still love Apple for the long term. So when Apple took a big drop It's like going to Macy's. If you see something on sale, you've been watching, it might be a good time to buy something.
I saw a call on Twitter. It had 20% upside. That was, this week, right? So there are some calls on a stock picker's market that you have to be very careful about what you're picking. Don't be broad-based. And you have to know your risk assessment. How much risk are you willing to take?
Bank of America Merrill Lynch came up with a research showing that over the last since 1950, looking at any correction or market sell-off more than 12%, there have been about 11 of them, of which 2 of them have been a swift recovery. And on average, it takes about 8 months for the market to bottom.
Remember March 2009, and we were like Dow 6,000, which was totally terrifying. But boy, what a buying opportunity that would have been. So anyway, thank you so much, Alan, Nicole, and Massud, for joining us.
Thank you.
Thank you. And thank you as well for joining us. We'll be right back.